Welcome back to Morning Trade Live. It's time to go inside out on Bank of America ahead of the report that's due out tomorrow morning. So far, we've heard from some of the banks, and it's been mostly good news, but the CEOs have come out with some language that has been a little cautionary, like from Jamie Dimon, like from Larry Fink, for example. Stephen Biggar is with us, Director of Financial Services Research at Argus Research. How are you feeling? We did get in, some of the others. We'll wait for Bank of America tomorrow. What's the big picture on these financials?
Yeah, hi, Nicole. So I think the numbers that are coming out for the first quarter are pretty decent. I think better than expectations. Of course, it was all before most of the tariff news. So yeah, the three main drivers: the lending growth, sluggish, which it has been with the higher interest rates, and a little bit of margin compression. Trading revenues for the banks, though, as we've seen from Morgan Stanley, Goldman this morning, and J.P. Morgan last week were just phenomenal, given all the volatility in the not only stock market but in fixed income, currencies, commodities. A lot of repositioning trades, and that's beneficial for trading revenues. And I would say very impressively, the credit costs have been not been a problem. We've seen from Fed data last week about some of the credit card delinquencies. The 30 and 90-day past dues are on the rise at a 12-year high. We've got some auto lending issues as well. It's a lot of repossessions going on. And yet the banks did quite well on credit costs. In fact, what we look at, the net charge-offs relative to average loans actually declined so far for all the banks. So that's encouraging, but doesn't account for, obviously, a potential slowdown later this year.
Understood. So for tomorrow for Bank of America, you mentioned, are you going to be watching for these exact things that you're talking about, and anything else in particular, the lending growth, the trading revenues, the margin compression? These will be some of the things you focus on for tomorrow, right?
Yeah, absolutely. And Bank of America, of course, a very consumer-facing bank, and the credit card side, and probably comparable to J.P. Morgan, which is what we saw last week, and still some reasonable growth there in the credit card lending side. That's been a big benefit for banks. But again, watching those credit costs, and if consumers start to run into trouble. And of course, it's still a very bifurcated market where you've got the high-end consumer still spending, still doing well, still keeping current on their loans, and but the lower end having struggling with inflation and higher cost of living, and having a little bit of more trouble on the credit cost side. So that's certainly will be something to watch with Bank of America. And then some of the other trends, of course, they're very strong in capital markets, and we'll probably see a continuation of the trends we've seen out of particularly the pure plays like Morgan Stanley and Goldman Sachs this morning.
Would you be buying any of these banks, whether it's the large money center banks, we have smaller banks, regional banks? Is this group for the financials overall one of that you would like for 2025, or not yet?
Well, we have been favorable on financials, and that includes the regional banks and the diversified banks. And they have fared a bit worse than the market. They had been holding their own through the first quarter. Certainly, and then some unwinding more recently. But we don't find the valuations to be expensive, particularly relative to some other parts of the market, like technology, for example. So these banks are trading at they tend to be low double-digit PE multiples. They're trading at 1.5 to 2 times book value. They've got yields of 3.5% and higher. So this is, tends to be a pretty good story for banks in terms of valuation. And there are a couple of catalysts. We're not entirely ruling out that capital markets recovery as we go later into this year. Certainly some uncertainty over the next quarter or two as the phone stop ringing with respect to investment banking, particularly the advisory and initial public offering market. And then one last catalyst I would mention is the regulations. I don't think the group has seen or has been given enough credit for the big regime change with the new administration, and capital requirements, and transparency to CCAR results and things like that. And that could result in some capital return improvements in areas like share buybacks and dividend increases for mid-year. So I think there are a couple of catalysts here, and I think the banks have shown or demonstrated their resiliency to some of these issues being faced today.
I mean, there's so many things. I mean, a new administration comes in and sort of like a wrecking ball, doing everything at the same time. Even people who love President Trump said, wow, he's doing so many things at the same time. I sort of wish he did them in a different order. But at the same time, that's his style, to come in and do all the, he's doing DOGE. He's trying to squeeze out extra costs. He's doing tariffs, maybe doing too much and then trying to peel it back. Concerned about the U.S. deficit and the debt that we owe, and trying to bring down the yields so that they can refinance that at a cheaper price, making sure energy is lower. Certainly taking on a lot of these things all at the same time. I don't know whether or not it's working. I'd like to leave politics out of it. But the big picture here is that's the idea, that we're laying the groundwork for everything better going forward. Do you think that while the economy may be, Jamie Dimon said that the tariffs are causing considerable turbulence for the economy, but in the long run, are you a believer that the market moves higher, the economy improves, and so on?
Well, that's certainly the idea, and I think the euphoria, if you will, when Trump came into office for various things in banking, and the group did quite well. And I think because it was that assumption that there was going to be reduced regulation, and that would help banks with their ability to lend, that rates would come down, that inflation would be a little more controlled, and of course that is a risk when you try to do too much all at once, and maybe we're there. But I would say that at least on the banking side, only very recently have we seen some of that regime change. Michelle Bowman, for example, as vice chair of supervision, was just brought in a few weeks ago. So that's going to take some time to play out. This notion of having a reduced regulatory environment for getting deals through, for example, on the M&A side. So we haven't seen much of that, and of course that's been pulled back and overshadowed by the tariff and trade policy news. So that as well is going to take some time to play out in terms of the ease of companies being able to get through, say, the Federal Trade Commission and Justice Department process.
Yeah.
So that should be easier, but again, that will take a little longer to play out.
And the $53 price target, I'm going to let you go. We're out of time, but we're at 36 and change. The $53 price target, do you buy some today before earnings? Do you wait till after earnings? How do you get into the stock of Bank of America? Because you do see the upside potential. How do you suggest someone does that quickly?
Sure. In fairness, yeah, the 53 was set before the all the turmoil that occurred. But again, we've seen banks consistently beat so far with good results to the stock price. So I would expect the same for Bank of America tomorrow.
Stephen Biggar, Director of Financial Services Research at Argus Research. Good to see you. Thank you so much. Appreciate it.
Thank you.
All right, George Tsilis is here because we're going to trade it now. You have an example trade, George, looking at Bank of America. In fact, this one is a neutral example. Tell us a little bit about this.
Yeah, I've got a neutral and a bullish one. We'll start with the neutral one. So one of the things about the market right now is implied volatility is still relatively rich. And if you're looking to capture that implied volatility or a high probability of it, you can certainly consider an iron condor or a credit combo with expiration coming up this week. So this is a narrow in terms of time frame, 3 days to the expiration. What I'm going to do in this case is I'm going to sell, because looking at the market maker move, it's around $1.80 per share, and that gives you an idea of the 1 standard deviation move post earnings based on the current price and expectations for market makers. I'm going to actually sell the 38.40 call spread that's above the current price, and below the current price, I'm going to sell the 34.32 put spread. So it's a four-legged structure. You could actually earn about 50 cents a share or $50 a contract in this case. So what I'm doing is I'm essentially looking for a range-bound move within the confines of that market maker move. On the high side, if we do get to break even, it's 38.50, and on the low side, it's around 33.50. So your max gain in this potential trade is 50 cents, but your potential max loss is $1.50. So if that's the case, That'll only happen if the stock does blow out on either side, 40 on the high side or 32 on the low side. So this is done for a credit. Ideally, the sweet spot in this trade is somewhere between $38 and $34 by expiration.
Okay. And that one was the neutral. You did mention you also have a bullish example trade. Let's take a look at that.
Yeah, so what am I doing in this case? Because again, the volatility for the near-term options based on the earnings and the market are very high. I'm going to structure a long call diagonal spread. I'm going to use the same out-of-the-money kind of concept by selling, in this case, the $38 call that expires this week. And I'm going to use that proceed, which is quite rich, to finance the in-the-money May monthly $35 call. So altogether, this is now traded for a debit of $2 a share or $200 a contract. So that's essentially what you can lose on this trade if it doesn't work out for you. Ideally speaking, the best position is for the stock to stay below the $38 by expiration, to which time, of course, the April contract will roll off, and then you basically have an in-the-money $35 call option that's unencumbered and has unlimited potential profitability. So it's a bullish trade that allows us to capitalize on near-term implied volatility premium, but it also allows us flexibility to let the stock continue to manifest through the third week of May if it does so post-earnings.
Okay. George Tsilis, great to see you. Thank you for those example trades on Bank of America. Appreciate it. Thank you, George Tsilis.